last year, our best-in-class thought leadership reports have demonstrated the reach and breadth of our spokespeople. The quarterly dividend index revealed that dividends in 2021 were much more resilient than we had initially anticipated. In fact, by Q3 2021, our study showed that 90% of companies globally had either raised their dividends or held them steady, one of the strongest readings we've ever seen. We expect for the positive news to continue for the final quarter of the year, as the exceptional strength of Q3 acted as a real driver to upgrade our forecast for the full year. Our summer edition of the Corporate Debt Report highlighted the widely diverging borrowing needs in 2020, primarily due to the uneven impact of the pandemic. Unsurprisingly, airlines, cruise lines, and resort companies were all among the hardest hit. On the other hand, the oil sector borrowed relatively little given how far oil prices fell. Our study also reflected North America's appetite to borrow, as companies located there owed half the world's corporate debt. Overall, companies around the world did, for the most part, weather the 2020 crisis with impressive skill. Our report revealed that global corporate debt had soared 10% to a record $13.5 trillion in 2020. In the wake of COVID-19, our inaugural sovereign debt report showed that to meet the challenges of the global pandemic, the world's governments took 8 years' worth of borrowings in 2020, increasing their debts by a sixth. As 8 in 10 countries in our index slipped into recession, governments added $9.3 trillion to their tab, equivalent to an astonishing seventh of the world's GDP.
It's been a real rollercoaster ride for dividend investors over the last couple of years. 2020 saw dividends fall 12% globally, according to our Janus Henderson Global Dividend Index, as the pandemic took hold and forced around a third of the companies in our index to either cut, suspend, or cancel their payments completely. The really good news is, however, is that in 2021, we've seen a really strong rebound. We think dividends are going to grow by around 17% at the headline level, 15% underlying, helped in a large part by some really strong special dividend payments, but also 2 key factors. The first one is the mining companies. Booming commodity prices have resulted in record levels of profitability, and these companies have returned that to shareholders via some large dividend payments, both regular and special dividends. It means that BHP is actually going to be the world's largest dividend payer in 2021. The second factor is the banking sector. In 2020, a number of regulators around the world stepped in to limit the payments that banks could make back to shareholders or force them to cancel dividends altogether. The good news is that 2021, some of that regulation has been lifted in most parts of the world, and banks have started to resume their dividend payments. And that has driven a large part of the growth we've seen in the last 12 months. With the banking dividends actually now only about 10% below their pre-pandemic levels, so really encouraging. A sharp fall in 2020 followed by a strong rebound in 2021 means that global dividends are actually now above their pre-pandemic levels, and we expect that growth to continue. So what do we see for 2022? Well, we think that we're going to see $1.52 trillion of dividends paid globally, and that's going to be growth of around 5 to 6%. Which is actually very much in line with our normal trend growth rate as we start to see things normalize and companies return to much more standard levels of payment, both in terms of the timings of their payments and the growth that they're going to deliver. So I think a more normal environment going forward, really encouraging, and some decent growth, 5 to 6% forecast for 2022.
Hi, I'm Matt Perrone, Director of Research at Janus Henderson Investors. I'm here to talk to you about the Janus Henderson Global Dividend Index, but from a U.S. perspective. In the U.S., dividends were quite resilient during the pandemic. The reason for that is because the U.S., by and large, has large buyback programs in place. As a result, U.S. corporations dramatically cut their buybacks and did not need to stop dividends as a general rule or curtail them in any meaningful way. As a result, in 2020, dividends were relatively flat. Moving into 2021, as the reopening commenced, Buyback programs were resumed as confidence was increased, and dividend gains were also put in place. So there were modest to significant dividend increases in 2021 as the reopening unfolded, albeit with some fits and starts. As we move into 2022, we expect more of the same. We expect earnings to grow at roughly 10% in the US, and dividends will probably follow. So unlike the rest of the world, the US was quite boring during the pandemic when it comes to dividends. And because of other levers that they had to pull, they were able to maintain their dividend programs. As 2022 continues, we expect more of the same, which is to say very boring, grinding towards record highs in dividends alongside earnings. That's our outlook on dividends. I'm Matt Perone from Janus Henderson Investment.
Hi, I'm Bethany Payne, Portfolio Manager with the Global Bonds team at Janus Henderson. Last year, we brought to you our first Sovereign Debt Index, a long-term study into the trends in government indebtedness. It measures the extent to which 50 of the world's developed economies are financing themselves with borrowing and how affordable and sustainable those borrowings are. We found that in 2020, the world's governments took on 8 years' worth of borrowing to fight the global pandemic, increasing their debts by almost a fifth. But despite sharply higher borrowing, the cost of servicing all this debt had not increased. In our second edition of the Sovereign Debt Index, we will look at how governments continue to borrow freely in 2021. While every country we looked in the study had increased borrowing, some countries had taken on more debt than others to face the challenges of last year. Despite the surging level of borrowings, governments still enjoyed extremely low interest costs. Moreover, the world economy has bounced back strongly from the pandemic lows. The global ratio of total sovereign debt to GDP fell as a rebound in economic activity increased. In our second edition, we will also be providing an update on global bond markets in 2022. We predict that this year will see global government debts climb further. While economic growth will support extra borrowing, indebtedness is likely to rise a little faster than governments and economies can grow. There are real opportunities for investors in bond markets right now. Over the last couple of years, the big theme in bond markets has been convergence, as governments and central banks provided huge coordinated levels of support to their economies. Now the theme is divergence. Regime change is underway, and governments intend to tighten policies through higher interest rates from central banks, and we're looking at the end of quantitative easing programs. This theme of divergence is a fundamental regime change and is key for more volatile markets. So we look forward to sharing our findings and views with you in the second edition of our Sovereign Debt Index early in the second quarter. Thank you for listening.
2 years on from the onslaught of COVID-19, and we're seeing the first time with unprecedented policy support being gradually unwound. Now, last year in 2021, we saw markets really have an attempt at pricing in the future path of cash rates and the unwinding of QE. But in 2022 is when we're going to see that great normalization of policy. And policy support is going to be unwound not only in monetary policy, but also fiscal. And that has profound implications for asset classes as well as markets. As an active manager, the biggest risk and of course the opportunity is when markets and indeed policymakers get it wrong. Principle amongst this is preserving capital in a rising rate environment in fixed income. Now, the policy unwind will have a range of implications for spread sectors like credit, both investment grade and high yield, and in particular, the highly leveraged entities which will be challenged. Meanwhile, more prudent areas of the economy and indeed corporates will benefit from the economic recovery. From a government perspective, the Janus Henderson Global Sovereign Debt study identified an unprecedented level of debt right across the world as governments really sought to fight and provide that safety net around various economies during the pandemic. Now, governments are now going to be challenged to provide further fiscal support, especially as their interest costs start rising as we move forward. At the raw end of the stick are perhaps emerging markets who really are fighting the double battle of inflation, higher costs, and are far behind developed economies in terms of the pandemic management. Developed markets, on the other hand, including the US, are better equipped to handle the normalisation of policy. And they really walk into the normalisation policy with a 50-year low in the unemployment rate, very strong and robust economic growth. The biggest opportunity we see for investors is perhaps not within credit, but rather risk-free government bonds, interest rate swaps, when markets overprice the future path of monetary policy that may never eventuate. A fascinating year ahead with many twists and turns expected, but ultimately restoring the defensive qualities of fixed income as an asset class and setting up for future better returns. Thank you.
Hello and welcome to an update on the corporate debt index. In 2021, we saw quite a significant increase in net corporate debt, and we're expecting something similar again in 2022, though maybe not quite to the same level as 2021. With the decent growth outlook we have following on from reopening from the pandemic, we're expecting an increase in capex, in dividends, share buybacks, and also M&A, which remains the one key factor to decide exactly how much net debt we'll have in 2022. What's really interesting though is that when we start to look within the market, if you take, for example, high yield, in fact, we might actually have net neutral debt issuance and possibly even net negative, because whilst there will be new supply to fund some of that M&A, we've also got rising stars, so those companies are getting upgraded from high yield ratings to investment grade ratings, and also the crowding out effect from issuance from things like the loans market and the private debt market as well. So that will impact and crowd out some of that issuance that we potentially have within the corporate debt market. But as we say, overall, we're expecting an increase in net debt, but it will be interesting to see that that's probably going to come with an improving credit quality as the strong growth outlook allows companies to get their balance sheets in better order.